GameStop stock surges 8% after hours. Record-breaking net income shocks the market. Let's dive into the details. First, regional performance and gross margin expansion. The income statement reveals a beautiful breakout by operational region, proving that every single region is performing exceptionally well. A key driver behind this success is GameStop's robust handling of macroeconomic pressures. Inflation is causing no grief for the company due to significant operational improvements made directly on the cost of goods sold. That is a remarkable achievement. In my opinion, this inflation defiance shows that management has finally found a way to insulate the business from broader economic turbulence. When comparing revenue growth against cost of goods sold, GameStop is displaying clear gross margin expansion. This is a feat very few retailers in the current market environment are managing to achieve. Most competitors are squeezing margins just to stay afloat, but GameStop is expanding theirs. That tells you everything about the operational discipline now in place. Moving past standard operating income, let's discuss below-the-line financial growth and derivative gains. The below-the-line items show incredible strategic execution. Asset optimization is a key factor. The company suffered significantly fewer asset impairments during this period. That means they are not writing down the value of their holdings as aggressively as before, which signals better capital allocation. A massive highlight is the substantial gain on derivatives, specifically highlighted as an unrealized gain on derivative assets in file 100,048,553.1.jpg. Part of this gain is tied to economic exposure to shares of eBay via put and call option transactions. This is not passive investing. GameStop is actively using derivatives to generate profits while managing risk. Even if a formal deal does not materialize, the unrealized items indicate that GameStop is successfully generating profits from these market positions, regardless of the final outcome. In my opinion, this derivative strategy is one of the most underappreciated aspects of the entire turnaround. Most retail analysts ignore these gains because they are non-operating, but they add real cash flow and strengthen the balance sheet. The company has essentially de-risked its eBay exposure by turning it into a profit center, no matter what happens next. Now let's examine balance sheet strength and cash flow optimization. GameStop's financial positioning has evolved into a powerhouse framework, as detailed across files 100,048,554.jpg and 100,048,557.jpg. The $9.7 billion liquidity mix. The company is sitting on a massive $9.7 billion war chest composed of cash, cash equivalents, marketable securities, digital assets, related receivables, and collateral pledged for derivative assets. This is not a typical retail balance sheet. This is a fortress. Asset rebalancing has also been executed with precision. The company successfully shifted approximately $700 million off its cash and financial instrument-related asset mix, keeping them heavily in the game. They are not just hoarding cash, they are actively deploying it into instruments that can generate returns while maintaining flexibility. And then there is the share repurchase program. Backed by this immense capital, the board of directors has officially authorized a discretionary $2 billion GameStop share repurchase program, valid through June 2, 2029. This signals immense executive confidence and a stark departure from how traditional corporate executives manage capital. Most CEOs would hoard that cash or waste it on dilutive acquisitions. Instead, GameStop is returning value directly to shareholders while keeping the option to buy back stock over a 5-year window. That is aggressive and confident. In my opinion, the buyback alone is enough to drive long-term share price appreciation, regardless of what happens with the core retail business. Let's turn to the first quarter key financial performance highlights. The first quarter metrics represent historical milestone achievements for the company. Net income came in at $389.6 million. That is a record quarterly net income in company history. It represents a strong beat of 0.30 over the expected 0.16. Operating income reached $143.3 million. That is the highest first quarter operating income ever, compared to a $10.8 million loss in the same period last year. Net sales hit $835.3 million, jumping 14% year-over-year from $732.4 million. The core revenue driver is collectibles. Sales surged to $348.9 million, making up 41.8% of total net sales. That is a massive shift in the revenue mix away from traditional gaming software and hardware. Collectibles are higher margin, more resilient, and have a passionate customer base. Meanwhile, SG&A efficiency has improved dramatically. Selling general and administrative expenses reduced to $201.6 million, down from $228.1 million in the prior year's first quarter. So they grew revenue by 14% while cutting overhead. That is textbook operating leverage. In my opinion, this combination of revenue growth and cost discipline is exactly what turns a struggling retailer into a cash flow machine. Now we need to talk about the strategic horizon and the early earnings release analysis. The financial statement inferences provide an incredibly compelling look into executive strategy. GameStop purposefully dropped its earnings early and entirely without notice. That is unusual. Most companies announce earnings dates weeks in advance and then hold conference calls. GameStop just released the numbers and let the market react. This sudden release strongly suggests that management intends to aggressively pursue the eBay acquisition. By getting the required regulatory financial disclosures out of the way immediately, they clear the path to make definitive strategic progress in the crucial period between the two annual shareholder meetings. Think about the timing. If you were planning a major acquisition, you would want your latest financials public as soon as possible, so you could move forward with due diligence, financing discussions, and shareholder outreach. Dropping the earnings without warning also prevents leaks and short seller positioning. The market wakes up to a done deal on the financial front, and the stock reprices instantly. And let's not forget the eBay connection. The derivative gains we discussed earlier are tied to eBay shares. That is not a coincidence. GameStop has been building an economic stake in eBay through options, while simultaneously positioning for a potential acquisition. Whether they buy eBay outright or simply continue to profit from the derivative positions, the company wins. And if they do pursue the acquisition, the $9.7 billion war chest gives them serious firepower. Even a partial acquisition or a strategic partnership would reshape the collectibles and e-commerce landscape. Finally, this is a masterclass in meme evolution. The data illustrates why tracking GameStop remains so vital. The CEO's strategic maneuvers, financial inferences, and structural implications are entirely unboring, far from obvious, and actively reshaping the company's long-term corporate identity. This is not the GameStop of 2021. That was a short squeeze driven by retail frenzy. This is a fundamentally different entity. Record net income, expanding gross margins, a $9.7 billion liquidity position, a $2 billion buyback, and derivative gains from eBay exposure. The company has transformed from a brick-and-mortar video game retailer into a diversified holding company with a retail core. The collectibles business is now the largest revenue driver.
Thanks for watching. If you found this helpful, hit that like button and subscribe for more.